All right, here's a good starting point for how to prioritize which accounts to use for saving and investing. The first one is very basic, but it is important, and that is a high yield savings account. Before you even think about maxing out a Roth IRA or contributing to a 401k, you need to have a chunk of money in liquid cash for emergencies, like for when your son decides to throw your phone in the toilet. More realistically though, you need some cash in the event you lose your job or have a medical emergency or a disaster with your house. Now, the generic recommendation is having 3 to 6 months of your basic living expenses on hand, easily accessible. And I think that's a good starting point, but it ultimately depends on your own risk tolerance. Ask yourself, what amount of cash sitting in my savings account would give me peace of mind? Maybe keep that much in cash. Ally Bank, Citi, American Express, they typically have competitive rates on high yield savings. Now, once your emergency fund is set, I would prioritize getting your 401k match if your employer offers it. This is free money, typically matching 3 to 6% of your salary, and there's really no reason to leave it on the table. Now, one common misconception is that you have to contribute to the traditional 401k to get the employer match. That's not true. You can contribute to the Roth 401k and still get the match, but the employer match will go into the traditional bucket. Now, once you've contributed enough to get the employer match, I would then target the employee stock purchase program if your employer offers it. An ESPP allows employees to buy their company stock at a discount, typically 15%. There's usually a 6-month offering period where a portion of your paycheck is set aside, and then at the end of that 6 months, the company uses those contributions to buy company stock at the discounted price. At that point, you can sell the stock, lock in the 15% discount as a guaranteed gain. Now, that 15% discount is taxed as ordinary income, but there's no additional tax on the stock if you sell it right away. So it's essentially a low-risk way to get some guaranteed gains with very little effort. Now, it does make your cash flow a bit lumpier because your paycheck will be less during the offering period, but then you'll get all that back plus the gains at the end of the 6-month period when you sell. So just something to keep in mind. Next on the priority list is the health savings account. This, in my opinion, is the best retirement account out there because it's triple tax advantaged. So you get a tax deduction for contributing to it, regardless of income, by the way. That money grows tax-free, and then that money can then be withdrawn tax-free if used for qualifying medical expenses, which is why it's generally better to pay for medical bills out of pocket today instead of using money that's in the HSA, if you can afford it, so that the money in the HSA can continue to compound tax-free for the next 20 to 30 years. But this only matters if you actually get your money invested. So just every once in a while, go in there and just make sure that your money, your contributions are not just sitting in cash. You can contribute to an HSA if you are on a high deductible health insurance plan. So you have to meet minimum deductible and max out-of-pocket requirements. If you meet those, you can contribute up to $4,300 to the HSA for 2025 if you're on an individual plan, or $8,550 if you have a family plan. Now, once you hit age 55, you can tack on an extra $1,000 to those contribution limits. Another common misconception is that if your employer doesn't offer an HSA platform, you're kind of out of luck. It's not true. If you're on a high deductible plan, you can just go set up your own HSA account independently. Lively is a nice user-friendly platform with plenty of investment options. Now, once you've maxed out the HSA, we can move back into the 401k or the Roth 401k. Now, I place this above the IRA for a couple reasons, although an argument could be made to prioritize the IRA over the 401k, but I'll get into that. With the 401k, your contributions are automatically deducted and invested each pay period. This makes it a great set it and forget it option, and it removes the need to manually invest your money each month like you would with an IRA. Within a 401k, you also have predetermined investment options, and most 401k plans have cheap index funds that should provide a well-diversified investment for a low cost. You also don't have income limits like you do with IRAs. If you make too much with a Roth IRA, you may not even be able to contribute to it directly. So you'd have to do the backdoor approach, which is fine. It's just an additional step, and you may run into tax complications if you already have money in a pre-tax traditional IRA. You don't have to worry about any of that with 401k. You can max out the Roth 401k regardless of income. And that brings us to the decision of Roth 401k versus traditional or pre-tax 401k. Personally, I tend to favor the Roth 401k because we don't know what future tax rates are going to be. With $36 trillion in national debt and rising, I think it's unlikely that tax rates will be lower in the future, although I could be wrong. I like the peace of mind knowing that my money is not going to be taxed again. And I've done a whole video explaining why I don't see the government ever retroactively taxing the Roth account, so you can go check that out. But ultimately, what is right for you depends on your situation. For 2025, you can contribute up to $23,500 into the 401k on top of what the employer contributes. If you're 50 or older, you can contribute an additional $7,500 on top of the $23,500. That brings us to the next one, where we take the 401k a step further with the Mega Backdoor Roth 401k. If you are a high earner and you're looking to maximize tax-free savings, the Mega Backdoor Roth 401k is a game changer if your employer offers it. So some 401k plans allow you to make after-tax contributions above the normal $23,500 limit, meaning you contribute dollars after tax, but you don't get a deduction for it. It's this third bucket. These contributions can then be converted into a Roth 401k, giving you even more room to build your tax-free bucket. So for 2025, you can actually contribute up to $70,000 into your 401k between your 401k contributions, your employer match, and the after-tax contributions. This is called the 415C limit. Direct Roth 401k contributions, those are going to be capped at $23,500, which I mentioned earlier. And then let's say your employer matches $10,500. That means you could contribute an additional $36,000 into the after-tax bucket to get to the 415C limit of $70,000 for 2025. But that amount can then be immediately converted into a Roth 401k. So that would allow you to put almost $60,000 into a Roth 401k in a single year. And you could even convert the employer match, although there's going to be tax implications to that. So you have to see if your plan offers this. They have to offer after-tax contributions and the ability to do in-plan Roth conversions. Does require some effort and some planning, but I think worth the payoff. Now, once you've maxed out your 401k, then we can move on to the IRA or the Roth IRA, depending on what makes sense for you from a tax perspective. Now, the nice thing about the IRA over the 401k is the flexibility and control. Unlike a 401k where your investment options are limited to your employer's plan, in an IRA, you can choose from a wide range of investments. If you prefer a hands-on approach to your investments and you just prefer having more investment options, prioritizing an IRA over a 401k may make more sense. Or if your 401k just has hefty fees. But with the IRA, the contribution limit is much lower than the 401k at $7,000 per year or $8,000 if you're 50 or older. And remember, with the IRA, you have to manually invest your money that you contribute each month. So it does require a little bit more effort than a 401k. And unlike a 401k where they'll typically auto rebalance for you, you'll have to rebalance yourself in an IRA. Either way, great way to build some more tax-free wealth. After that, we can start exploring putting money into a taxable account. Now, this is just a standard brokerage account. This account gets glossed over a lot, but I truly believe that it is one of the most important investment accounts to have. What I love about the brokerage account is, and why I think it's so important, is there's no contribution limit, so you can contribute as much as you want in a year. There are no income limits for contributing. There are no withdrawal limitations. You have unlimited investment options, and you just have tax flexibility. Flexibility is really the key theme here. If you have aspirations of backing down from work full time before age 59 and a half, that's the age where you can pull out of your retirement accounts without penalty, then building some wealth in a brokerage account is a non-negotiable. And if that's the case, this may need to get moved up the priority list, probably after you max out the 401k, but maybe before you do the Mega Backdoor Roth. The precise order of all this depends on your exact situation. But if you plan to stop working before age 59 and a half, you should start building some wealth in a taxable account. Now, if you plan to work into your 60s, then prioritizing the retirement accounts mentioned previously is a reasonable approach. Either way, I think it's good to have something in the taxable brokerage account because in an ideal world, you accumulate wealth in 3 tax buckets: the tax-free or the Roth, the tax-deferred, this would be the traditional IRA and 401k, and then third would be taxable or your traditional brokerage account. So having investments in these 3 different accounts that are all taxed differently provides you with tax diversification and tax flexibility when you do go withdrawal. In years where you have higher income, you could pull from the Roth and or the taxable. In years where you have lower income, you could pull from the traditional, where those withdrawals will be taxed at a lower rate. Research has shown that optimizing your taxes during the withdrawal phase can actually extend the life of your portfolio or how long your money lasts by 3 to 6 years. And in order to optimize taxes during that withdrawal phase, you have to be intentional with where you invest those assets during the accumulation phase. And the taxable account provides that additional layer of flexibility. So don't forget about this one. And then that brings me to the last one, and that is the alternative investment vehicles like real estate, whether that be direct ownership or real estate syndications or private equity investments, whether that be directly into a private business or your business or through a private equity fund. I'm a big fan of diversifying assets and future income streams through non-traditional investment vehicles like real estate and private equity, but they do require more time and skill to find the right deals that will actually compensate you for your risk and time, which is why I put it last. It's not everyone's cup of tea, where all the others pretty much anyone can take advantage of. All right, that's it. Thanks for watching. See you next time.